In life, we are told not to have all our eggs in one basket. In investing, this translates into diversification. An investment portfolio, we are taught, should combine a variety of assets to reduce the overall risk and help protect against market swings. Over time, a diversified portfolio should help provide an acceptable level of risk for a given expected return. The trouble is, diversification has failed in recent years and actually penalized investors, not benefited them. In fact, diversification has failed to benefit investors in 3 of the past 4 years. Large company U.S. stocks have proven tough to beat in recent years, and diversification into mid and small company stocks, bonds, as well as international and emerging market stocks has lagged performance of large company U.S. stocks. Does this prove that diversification is dead? We don't think so. A closer look at whether diversification is a benefit or a penalty reveals that the potential benefits of diversification are often cyclical. Diversification benefits fluctuate, just like the market. However, over the past 15 years, a period that includes 2 recessions, diversification has worked more often than it has not. The benefit or penalty of diversification can go on for long periods of time, but in recent years, there's been a diversification penalty. Over time, we expect this condition to reverse, just as it has historically, and diversification will likely benefit investors once again. We still believe diversification can help buffer against the market's ups and, more importantly, downs. This chart illustrates how asset classes go through periods of strength and weakness over time. The whipsaw in investment performance across sectors from 2008 and 2009 shows how markets can overshoot during periods of gloom and doom and can similarly do so to the upside. Predicting which sector will lead in any given year is an impossible task, and diversification can help mitigate against the unpredictable swings. Whether it is a smoother ride towards your financial goals with a stock and bond mix, or a longer time frame where a greater allocation of stocks is warranted, diversification may still help you meet both objectives. Another common question is whether alternative strategies make sense as part of a diversified portfolio. Like other segments of the market, alternative strategies have failed to match the performance of large company U.S. stocks from 2009 to 2014, as shown by the HFRI index. Alternative strategies have underperformed the S&P 500 index by slightly more than 11% annualized as of the third quarter of 2015. In our view, alternative investment strategies can still be an effective diversification tool despite having disappointed some investors' expectations in recent years. Note that since 1996, alternative investments have only underperformed both stocks and bonds in 4 calendar years, or 20% of the time. Adding AI strategies to a portfolio that already includes bonds may enhance risk mitigation. We believe AI strategies are a tool to help mitigate risk, but do not replace stocks and bonds. AI strategies may reduce portfolio risk, but high-quality bonds have historically provided a better buffer against stock market risk. Therefore, a small allocation of about 10% may be sufficient to mitigate risks without detracting from return potential, although investors with different risk tolerance and investment objectives may wish to increase exposure either up or down. Feeling empowered with the knowledge of why to diversify, we turn our attention to the question of when. Is there a way to know in advance when diversification will help or hurt investors? There's no single reason as to why diversification benefits do not materialize, but the level of overall volatility seems to play an outsized role. Our analysis shows that a 24-month moving average of the VIX index, a measure of volatility, is a leading indicator of when diversification may work. When readings have been above 24, a diversified portfolio has outperformed the market 88% of the time by an average of 5.7% over the next year. In periods when volatility has been low, diversified investments have trailed the S&P 500 by almost 4%. A reading between 15 and 24 is a push, and diversification neither helps nor hinders performance. Since we believe in the benefits of diversification over the long term, we would suggest being diversified even if the VIX is not providing a clear signal. However, at the extremes, volatility can help identify when diversification may work or when a bias to large company U.S. stocks may be prudent. Low volatility can signal that investors are not being properly compensated for risk, and explain why diversification may not work under that condition. Conversely, high volatility can be unnerving, but usually means asset prices are lower and offering a significant buffer to investors against risks. Overlaying our VIX moving average measure onto the diversification benefit and penalty chart shows that volatility explains a good portion, but not all, of the diversification benefit over the longer term. At the start of the fourth quarter of 2015, the 24-month moving average of the VIX stood at 15.9, a neutral reading. We still argue for a diversified portfolio, as it may smooth out the journey for investors working towards achieving their financial goals. We hope you found this material helpful. Thanks for listening.